Fasten your seatbelts. Against the euro, the pound, and the Swiss franc, the loonie has already lost altitude. Only against the US dollar does it appear to hold steady. But that's an illusion. If the Canadian dollar catches down to the global trend, Canadian investors need to get ready for some turbulence. The Canadian fiscal picture is worsening. Deficits are projected at approaching $100 billion. Look, that would be worrying in any context. But with trade frictions mounting, the risks are even higher. Ottawa has chosen bold positions, recognizing Palestinian statehood just days before a trade deadline, pursuing talks with Brazil, sidelining the fentanyl czar. These choices may well have merit, but in negotiations, timing matters. By contrast, Mexico has focused tightly on trade deliverables and security cooperation and has been rewarded with concessions. Canadians are right to ask, why can't we? Meanwhile, housing has already corrected. Do you know prices have dropped almost 18% since 2022? And that's before inflation. Banks look resilient thanks to capital buffers and mortgage insurance, but rising renewal and insolvencies will test that strength. Look, the banks have been stellar performers, up 56% in just 3 years. But much of that was driven by wide spreads and low losses, and those easy gains are now behind us. With recession risks rising, stock picking, not just broad exposure, will matter more. Commodities remain Canada's strongest card. A weaker loonie actually boosts energy margins. Our producers earn in US dollars and spend in Canadian. Leaner balance sheets mean they're ready if US shale slows further. What about base metals? Well, it's more complicated. China's slowdown is a drag, but US onshoring and grid build-outs are creating fresh demand. Agriculture is, of course, tougher. China's restrictions on Canadian canola remain a headwind that hasn't been resolved. So how bad could it get? Well, in 2002, the loonie sank to 62 US cents under similar conditions. Fiscal drift, US outperformance, weak commodity investment. If tariffs persist and deficit swells as the Bank of Canada has to cut rates, we could revisit the mid-60s. Now, investors aren't powerless. US equities, held unhedged, convert currency weakness into a tailwind. Energy and US-anchored exporters are natural hedges. Banks should be approached a little bit more selectively. Look, Canada still has time to act, to rebuild fiscal credibility, prioritize Washington, unlock stalled energy projects, and support productivity. If Prime Minister Carney delivers, he could go down as one of Canada's most consequential leaders. For investors, the path is clear. Diversify into the US, lean into energy and exporters, and be selective with the banks. The future is still in our hands, but it's time to fasten your seatbelts. I'm Glenn Evans from Evans Family Wealth. We're here to help.